Hi, this is Catherine from FSM Hong Kong. Today we are very glad to be interviewing Vanessa Chan, Fixed Income Investment Director from Fidelity International. So let's hear from Vanessa. Why do you think this asset class is popular with current investors?
Asian high yield offer one of the highest yield compared to Europe and US high yield. In addition, Asian high yield also offered abilities for clients to get exposure to one of the fastest growing Asia fixed income market, which has been offering over 20% growth for the past 3 years.
What are the key investment themes in your fund?
During 2018, we have experienced a lot of volatility in the market, ranging from emerging market weaknesses, China growth slowdown, and trade war. This weakening of market sentiment have led to spreads widening for second half of 2018. As we walk into 2019, valuation for Asian high yield is very attractive.
Were there any changes made to the portfolio as a response to significant market events?
We have been adding on risk gradually throughout 2018 that help us to capture the rebound in July, which benefit fund performances.
What events could affect your portfolio in the near future?
For the near-term catalyst for Asian high yield, first of all, we believe China easing bias and policy response potentially will be a catalyst. Any additional policy easing will be a positive boost to the market. Secondly, if a potential deal is reached between US and China on trade war, this will be a positive sentiment to the market. Finally, technicals could improve in 2019. Currently, the offshore US dollar bond market has been flushed with a lot of supply, which have created a supply pipeline. The revival of the onshore China bond market could potentially provide another alternative funding sources for corporates, which will be supportive for the fundamentals and credits of the Asian high yield market.
Why is your portfolio so heavily weighted in China?
Over 60% of Asian high yield are coming from China. If one person wants to invest in Asian high yield, they will get exposure in China. For China, we should think of it as a growth engine for Asia. The continuous growth of China market will provide additional new issuers, which will add breadth and depth to Asian fixed income market, which overall will provide more choices and opportunity sets for investors.
What is the outlook of China's property sector in the coming years?
The China property sector has 2 very good years in terms of contracted sales. In 2018, we believe most of the property developers will meet their contracted sales targets. They are also sensible and have started slowing down in terms of the land bank acquisition and pre-funded a lot of the refinancing requirement for part of the 2018 and 2019. For the longer term view in terms of the China property market, we believe it's still going to be stable with slightly positive bias. Urbanization rate in China is only at 50%. This is still relatively low compared to more developed economies whereby urbanization rates have reached 70 to 80%. Finally, property sector will continue to be an important economic pillar for the China GDP growth going forward as well.
How will rising interest rates affect the portfolio?
Duration of Asian high yield and China high yield is around 3 years for the asset classes. The short duration nature of the asset classes make it less sensitive to rising interest rate environment.
How will a slowdown in China affect your portfolio?
We do notice slowdown in various parts of the economy. Manufacturing and property are still holding up well, whereas infrastructure and consumption spending are weakening. However, the overall credit quality of China issuers are still intact. China is likely to continue to deliver growth of around 6% in GDP in 2019.
Hi, thanks for watching our video. Don't forget to like our Facebook page and comment down below for what you would like us to cover next. Stay tuned for our next video where our analysts from around the region will tell you about their favorite investment ideas of 2019.